There are tax rules in the UK that can reduce how much you pay on a property by tens of thousands. They're not hidden, they're not new, but somehow most investors have never heard about them until it's too late. And I've worked with hundreds of investors over the years, and this is one of the biggest mistakes that I see. Not understanding the tax side of things early on is the fastest way to lose money, even on a good deal. So in this video, I'm going to show you the biggest tax rules that smart UK investors are using in 2025 and how you can use them legally to save thousands of pounds. So a while back, I bought a complete wreck of a house. The kind of house that after you've been in it for a couple of minutes, you feel like you just need to go home and have a shower. You'd open the front door and get hit with that cold, damp smell of rot and brick dust. It was exactly the kind of project that I love. A full gut job with loads and loads of potential. We bought it, renovated it, sold it, but only afterwards did I find out something that it kind of made me cringe a little bit. We didn't need to pay stamp duty on that property at all. Now, if I'd known that at the time, I could have saved myself about £4,000 completely legally just by submitting the right paperwork. And here's how. If a property is uninhabitable when you buy it, because like the house that we bought, there was no working kitchen or no usable bathroom, basically no way someone could reasonably live there, HMRC treats this as a different kind of asset. It doesn't fall under your standard stamp duty rates. But most investors don't actually know this. So if you're buying a doer-upper in 2025, here's what you need to do. Take photos the moment that you get the keys. Focus on things like the bathroom, the kitchen, the boiler, the wiring. Show that the place isn't livable. Get a builder or a surveyor to write a quick letter confirming that it is uninhabitable. And once the deal's done, you can work with a tax advisor to file for a refund from HMRC. And here's a little known bonus. If you've already bought and renovated something like this in the past, maybe like year or 2 years, and you've still got evidence, you might be able to backdate that claim. And it's one of the simplest tax wins most investors miss. And it's why I always say the money isn't just in the deal, it's in the details. And just before we move on, if you're serious about investing in property in 2025, we've put together a free resource to help you. It's called the Property Investment Playbook. Inside, you'll find the exact frameworks that we use with our clients to spot profitable deals, avoid tax traps, and structure your purchases in a smart way. You can get access to it through the link in the description. Now, let me tell you about another tax rule most people don't realize exists. I've got a client who buys a lot of property who messages me every single time I send him a deal, and he says, does the seller own this in a company? If the answer is yes, then it opens you up to a very smart strategy. Instead of buying the property itself, he buys the company that owns the property. And because he's buying shares rather than bricks and mortar, he pays no stamp duty at all. Now, this isn't some loophole or a grey area tactic. It's fully legal, but barely anyone is actually talking about it. And it can make a massive difference, especially if you're buying higher value properties or a whole portfolio of properties. You just need a good solicitor to do proper due diligence and make sure that there's nothing dodgy inside the company that you're buying. So if you're planning to invest in 2025, especially at scale, make this a part of your checklist. Is the property owned in a limited company? Because if it is, and the seller's open to it, buying the shares instead of the asset could save you tens of thousands of pounds. This next one is something I've done myself, and it's hands down one of the most effective and efficient ways to build wealth without handing over huge chunks of cash to HMRC, which I'm not entirely opposed to. A while back, I bought the house that I live in now. I needed to do some work to it, so we renovated it, extended it. If I sold that today, we'd walk away with all the money that we put in, plus £120,000 in profit. And the best part is that I wouldn't pay a single penny in capital gains tax. Let me explain. Most people assume that if you sell a property for more than what you bought it for, you'll always owe tax on that gain. But if it's your main residence, the place that you actually live, the rules are completely different. As long as it's your primary home and not just something you pretend to live in, you get a full capital gains tax relief. That means you can renovate, build value, sell, walk away with the entire profit tax-free. And yes, this is totally above board. HMRC call it private residence relief. The only caveat is that you need to prove that it was your main residence. So make sure that your post goes there, you registered for council tax, you set up your bills, all in your name at that address. Because flipping a home that you genuinely live in, even for a short time, is one of the few ways in the UK that we can legally make 6 figures and keep every penny of it. Now, while that works brilliantly for your home, the minute you start building a rental portfolio, the rules change completely. And this next one catches out a lot of investors, especially when they buy their first few properties in their personal name. Most people assume property is taxed like a typical business. You earn income and then you take off all of the costs, like your mortgage interest payments, and then you pay tax on whatever's left over. And that would make a lot of sense, but that's not how HMRC treats property income when you own it in your personal name. Let's say you're renting out a flat for £1,500 a month, and your mortgage interest is £1,100 a month. On paper, it feels like you're making £400 a month profit. But when you own a property in your own name, you can't deduct the full mortgage payment from your taxable income. So you could end up being taxed on income that you've never actually seen. It's one of the most frustrating parts of personal ownership. You're making barely any cash flow, or sometimes even running at a loss, and yet you still owe tax. Now, here's the alternative. If you own the property through a limited company, that mortgage is treated like any other business expense. Your interest payments go in as a cost alongside repairs, insurance, letting agency fees, the lot. You're only taxed on your actual profit. What's left in your account at the end of the year. That's a huge, huge difference. It's why now all of my rental properties are owned through a limited company. Personally, I feel like it gives me more control over my cash flow, more flexibility with reinvesting, and crucially, it keeps my tax bill tied to my real profits, not some inflated figure. So if you're buying a rental property in 2025, especially with leverage, take 10 minutes to run through both scenarios, your personal name versus a limited company. Work it out properly, speak to your accountant, because choosing the wrong structure now can cost you for years to come, and switching later isn't always easy and will often mean that you have to pay stamp duty. Now, tax is just one piece of the puzzle, because even with the perfect tax setup, one wrong move during the buying process can cost you way more than your tax bill. In fact, we've mapped out all 31 steps you need to take before buying any property in 2025, from due diligence to financing to legal traps that most people miss. If you want to get the full breakdown, then watch this video next.